Hello, everyone, and thank you so much for joining us today from whatever corner of the world you are in. My name is Sarah Jane Demy, and I am the founder and CEO of Demy-Colton, and I am located here in New York City. It is my pleasure to welcome you to the 7th installment of the Demy-Colton Virtual Salon Series, which will be a fireside chat with Mike Gaito of JP Morgan, who will be interviewed by Dennis Purcell. As many of you know, Demy-Colton's mission is all about bringing biopharma and digital medicine industry leaders together to catalyze change. We know we can help drive innovation when we bring individuals together who are united by a common cause and a shared passion. And in our industry, that cause and passion is bringing therapeutics and cures to people in need. And we were in the process of launching our new International Business Development and Investor Conference, BioFuture, right here in New York City, when COVID-19 hit and changed everything about what we do and what you do. So in lieu of our in-person BioFuture conference, we launched the Demy-Colton Virtual Salon Series to continue our mission of bringing people together with great content. I would like to take a moment to recognize and thank all of our sponsors who have resolutely stood with us during this challenging time, and indeed, whose support has broadened and evolved alongside our programming. At Demy-Colton, we believe the Virtual Salon Series will be here to stay even after we get back beyond COVID and get back to whatever the new normal will be. So please check our website for the schedule of salons, fireside chats, topics, and participants. And of course, I encourage all of you to join us at future events. A note about the structure of today's program. The formal portion of the discussion will last approximately 50, perhaps 55 minutes, and it will be followed by a 15-minute Q&A period. You can submit questions in the Ask a Question pane below the screen, and we will address as many as possible. Please note that the salon will be recorded and will be available for on-demand viewing later today. As I noted earlier, today's virtual salon is a fireside chat led by Dennis Purcell and featuring Mike Gaito of JP Morgan. Dennis is the founder of Aisling Capital, a leading healthcare investment group located here in New York City. Previously, he served as senior managing partner of Aisling, and prior to that, founding Aisling, Dennis was the managing director of Life Sciences Investment Banking Group at Chase H&Q, sorry about missing the Chase. While at H&Q, Dennis was directly involved with over 200 completed transactions and supervised over $10 billion in financing and advisory services in the pharmaceutical, biotechnology, and medical products industries. He has been a leading figure in the biopharma space since the 1990s. And I believe that's when I got to meet Dennis, way back then. Mike Gaito is the global head of JP Morgan's Healthcare Investment Banking Group. Over the course of his 24 years with the firm, Mike has advised on some of the largest transactions in the history of biotechnology, including advising Pharmacyclics on its $21 billion sale to AbbVie and Medivation on its defense and ultimate sale, a $14 billion sale to Pfizer. Mike originally joined JP Morgan as part of Hambrecht & Quist's, or H&Q's, Healthcare Investment Banking Group in New York. Before I turn the virtual podium over to Dennis and Mike, please note that Mike will not comment on any specific company or transactions, as I'm sure you would expect. Dennis will join us at BioFuture, which will take place in April 2021. And Mike, you are also invited to join us there as well. It may be a virtual event. It may be an in-person event. It will take place. Now, without further ado, Dennis, the virtual podium is yours. Dennis, Mike.
Thanks, Sarah. Good morning, everybody, or good afternoon for those of you in Europe. And Mike, good to see you.
Good to see you too, Demy. Thanks for having me.
one of the things I always look forward to is our Sunday morning breakfast with John Rumsey from Aquila Partners, the second Sunday in January, right before the JP Morgan conference. It's probably the last quiet time you have before the conference. But for the first time in 30 years, the St. Francis Hotel won't be crowded during that week in January. A few days ago, you said that the conference was going to go virtual. So I guess we have to postpone our breakfast till next year. But people have been talking about that and wondering, how did you decide to make it go virtual?
Sure. Well,
yeah.
Go ahead. Sorry, Dan.
No, go ahead. No, how did you decide?
So it was a tough decision. We debated it for a long time and tried to hold on as long as we could to try to have something in person, because this was our 39th annual conference, and as everybody knows, it's a great industry-wide event. And I think the neatest part of the conference is what happens while what's ever in the halls is fantastic and in all the presentation rooms, but outside of the conference, where just about the entire industry shows up to San Francisco and tons of BD and tons of investment opportunities all happen. So it was really a daunting thought to think that we wouldn't be able to do something or might not be able to do something in person. So we held out as long as we felt like we could. We pushed the hotels to be flexible, or try to get the hotels to be flexible on deposits and things. But as we continue to just gather data and see how the virus is evolving, and speaking to the mayor of San Francisco in their office, we just couldn't get enough sort of positive encouragement anywhere that felt like we could do this safely. And in San Francisco, we don't even know when large gatherings will be allowed again. And that was something that just no one could give us any sort of a good read on. So it just felt like, to be prudent and to be careful with everyone's health, and not to waste anybody's money on hotels and all that, we just decided that it would be best to be virtual.
About or the breakout session, all the rest of it, or is that still a work in progress?
You broke up a little, Dennis. Say that again, please.
Yeah, I'm sorry. Have you figured out what the format it's going to be?
Yeah, we're still working on it. I think it'll be relatively similar. We'll most likely have public companies present maybe a little bit longer, and maybe tack on a little Q&A at the end of their session, rather than having the breakout sessions that we usually have for public companies. For private companies, it'll be very similar to what it always has been. And I think we're gonna host probably more, at least if you follow what's been happening with these virtual conferences, we may host even more investor one-on-ones than we have in a live setting, just because there's a lot of flexibility, and we can have a lot of people on these Zooms.
Yeah. Mike, how do you decide who presents at the conference?
Yeah, that's a great question, and a timely one. So just like it always was at H&Q, Dennis, this is a research conference first. So companies under research coverage at JP Morgan present or are always given presenting spots. And then after that, the research analysts and the bankers all nominate clients. So it starts with, clients of the firm under research coverage, then other clients of the firm. And then we think about sort of future prospects, and we think about, what we call institutional relevance. So it's a research conference and it's an investor conference. So we always want to have companies that are relevant to the investor institutions as well.
Ranking, you guys are number one. I don't know if people realize how big a practice, the healthcare practices at JP, more a little bit about that, the size and scope of your practice, people and offices and products.
Sure. Well, it's much bigger than our practice was at H&Q. So we have and I think most of the big banks now have a really global approach to healthcare. And all of us in North America work with our colleagues. And to your question, we have offices in London. We have a big team. We have a large team spread around Asia Pacific, and we have a team in Latin America as well. So multiples of what we had at H&Q. And the really neat thing is that all of us, North America is really a hub for a lot of what happens in our industry. So we have a lot of our North American team does lots of work. So that's a real big difference from where things were back when I worked for you at H&Q, where we have people collaborating across borders, helping clients, whether that's Asia, China companies trying to list in the U.S. or European companies listing in the U.S. or cross-border M&A. So we have a really vibrant sort of global franchise, and it's really been great to see it, the way that the industry has burgeoned and become so global.
And do you guys in the healthcare group work with the other parts of the bank, or are you kind of isolated?
No, we were, from the healthcare group we think of as an industry group. So we're starting to work more and more with other industries. There's, healthcare fingers going into lots of other industries, whether it's our diversified industries group or our technology group, occasionally the media group. So yeah, especially with the advent of sort of digital health and all the technology that's moved into healthcare, we do a lot with the other industry groups, a lot more than we ever used to. And then, of course, every single product that the bank offers, our clients utilize. So whether that's M&A or equity capital markets or debt capital markets, we're incredibly busy, and we're year in and year out, we're generally one of the larger franchises in JP Morgan's investment bank.
And given so many companies want to work with you, how do you decide which companies to take on? I'm sure you got to pick and choose. How do you do that?
Yeah, it's sort of funny sometimes we when we go through the client selection process, which is, the bigger the franchise, the harder it is, whether it's client conflicts or where you can't be working with sometimes competitors. But some of our partners across the bank, are surprised to hear that we occasionally turn down business. But we're fortunate enough to have a lot of flow and a lot of relationships. We have the core of our healthcare team has been around for more than 20 years. So the neat thing is healthcare and biotech specifically, it's a pretty insular universe. So we see a lot of people that, in different jobs and in different companies. So we're lucky enough to have lots of great relationships from over time. And I think our team has probably stayed together more than a lot of other teams where we just haven't had a lot of movement. So that's a wonderful way to find clients and to choose clients. And then the other way is we're it's all different, right? So on an equity prospect, we always want to make sure that the research analysts are supportive. So that's we have a vetting process where if we're going to do a financing for somebody, we work with our research analysts to vet the companies. If it's outside of equity, it's really just it's a combination of all of our collective experience and expertise trying to figure out, what a company's prospects are like, what is their growth opportunity, what markets they're in, obviously investors and board members make a big difference. So it's a whole range. It's a whole range of things.
And what kind of approval process do you have to go through before you do a transaction? Is there a commitment committee, or is there a committee inside the bank that says, yes, go ahead and do this IPO or do this follow on?
Sure. Yeah, most of the banks have an equity commitments committee. Anytime we're issuing debt, we have a committee as well. Everything else is generally, there's really just a sort of a conflicts approval process that I oversee that just tries to make sure that we're not getting ourselves into any competitive hot water or with any challenges working with a particular company. But our MDs are all very experienced, and we use good judgment, and it works out well.
Yeah, one of the things you didn't mention, how many people work in the healthcare business worldwide in your franchise, roughly?
Yeah, we're well over 100. I won't say absolute number, but yeah, well over 100. Probably, and I would say it's hard to really tell. I would say we're probably not even the largest of the large bank groups, numbers wise. We're probably 60% or so North America, and that's split between New York and San Francisco, heavily New York, and then probably, roughly 20% each in Europe and Asia Pacific, and then a small Latin America effort.
Yeah. And Mike, there's a lot of private companies in the audience, and at some stage they'll be thinking about an IPO. If you're a private company thinking about going public, how in an investment banking relationship, or how to do it, how to pick a bank?
Oh, sure. So the IPO markets have been unbelievable this year, and really for the last couple of years. And I remember
we're going to get to the market in a minute. But how would you pick a bank?
Yeah. Sure. I think one of the things that we always talk about is just execution experience and expertise. I think about performance of deals. I think about sort of quality of deals, and a lot of people have different bars for that, whether it's performance or whether it's how well the companies fare in the future, or how strong the team is around a particular company. So those are all things that I would look at, and those are all things that we probably not surprisingly that we all think about quite a bit, and we consider whenever we're working with companies. So I think investors, public investors are also a good reference for companies to talk to. And I like to think that public investors know that a JP Morgan transaction has summited a very high bar, just in terms of quality of story of people and of overall company. So those are the ways, at least, we think about it.
And it's kind of an unfair question, but generally, how many banks should be on the cover of an IPO? Why should CEO, CFO think about that? Sure. And I know there's no right answer to that, but
yeah. A lot of it depends upon size, Dennis. And we think about there are certainly more book runners these days than there used to be. But we think about something like 2, 3, 4 banks, and a combination of book runners, 1 or 2, or occasionally 3 book runners, and then maybe a co-manager or 2, and that that can be a larger, those syndicates can get larger with larger deals. And, the deal sizes have crept, obviously over time. So, the old $100 million deal is the old $50 million deal, I think, when we were at H&Q. So that supports a little bit more activity. The tricky thing is a lot of times, there's a lot of management teams and boards feel a lot of pressure to add banks and feel that they want to have a big group, and just sometimes it can get unwieldy. And from an execution perspective, we find keeping the execution to a bank or two who's really on the hook and driving things leads to the strongest outcome.
And Mike, you know this, in the old days, research and how the bank traded your stock. Are they still key factors when going public and trying to pick a bank?
Sure. Yeah. Research is research, I think, is always going to be important. It may be somewhat less important in some other sectors as the buy side has gotten so strong and started to do so much of their own work. But I think in biotech, it will always have a good bit of relevance. Not to say our buy side investors don't have much more expertise than when I first started in the industry, and don't have a lot more internal capabilities. But there's an element of biotech that really needs and helps to have just analysis of trials, of drugs, of competitive landscapes, of what competitor trials are doing. So all that we think is relevant, and we think it's very important. And as I said, our vetting process is a vetting process where we equally weight the research view and the banking view, and we think it's a lot more important, I think, the research view than some of our competitors do. So it's something that we think about really seriously, because it's part of the holistic relationship. The trading side, then, is a little bit different. It's a little less looked at now, just because there's so much trading that goes through the pipes, so to speak. So there's much less high touch trading. So we track it, we keep an eye on it, but the liquidity is coming from so many different places that it's not as critical a factor anymore.
Yeah. I want to get to the whole IPO scene in a minute, but if we just look at like the global the fundraising, in total, 2019 was a record year. And the first half of 2020 was more than all of 2019. Yeah. And the second quarter this year itself, second quarter of 2020, was more than most years just in that quarter. And you mentioned this at the beginning, what 6 months it's been. I mean, it's unbelievable how much money is being raised. So kind of on a personal note, what have the last 6 months been like for you? What's work been like?
Yeah, it's as I'm sure everybody's experienced, it's been wild to see how busy things have been. As you said, it's shocking, just how functional the financing markets have been for us. So when I looked the other day, I think this year we've already outpaced last year by billions of dollars. I think we're at 18 or so billion of IPOs and something like almost 50 billion of follow-ons this year, and that compared to 13 last year of IPOs and maybe 30 of follow-ons. So it's just been incredible. And to think about, reinventing the way you do these deals and doing things all in this sort of Zoom environment. It's been incredible. Now, the the IPOs were the last sort of bastion of in-person meetings that we had. The IPO roadshows, the follow-ons had already generally moved to telephonic, so that wasn't a huge difference. But just everything, starting the process, doing the diligence, drafting documents, all of it has just been, it's been amazing how efficient it's been. I think it's been a little bit taxing on people. I think everybody just feels that everybody talks about that line between the work life and the home life is a little bit harder. So we try to encourage our folks to try to find that balance. It's hard when you've got as much deal flow as we've all seen, but it's been really great to see the team be able to execute and sort of stay together. And we try to maintain the culture as best we can and all the connectivity. So it's been rewarding, but it's been challenging.
Yeah. Well, on that note, how do you think it'll change going forward? How do you think your work life will change going forward now? Will it change going forward? Is there a new normal for you now because of the pandemic?
Right. It was interesting to see that we could be just about as efficient, maybe even a little more efficient in a work from home environment. But the thing that starts to worry you or you start to think about is just culture, and that creativity that you get when everybody's together. That's been the thing I think I missed the most. And as I said, we've been trying to come up with different ways to encourage that, which I think have been helpful. But there's no substitute for being together and just talking through stuff and experiences and sharing ideas. So will there be a little less travel? Will there be a little less in-person stuff? Maybe a little. I can't imagine. This is really an in-person business. It's hard to. I mean, one of the ways we pick clients and clients pick us is just to try to get to know a person. And in a Zoom meeting where everybody's in a different location, it's just hard to really get a feel for people and how they work with their teams and things like that. So I think we may have a little bit less in person. We may take advantage of Zoom, everybody's Zoom expertise or whatever their virtual meeting place of choice is. But I don't think it'll be that much different. I think we see the efficiencies of a virtual roadshow. We may see fewer in-person IPO roadshows. I'm not sure if every single deal will go back to the in-person roadshows, just in the way that the follow-ons evolved over time from in-person to much faster and much more telephonic processes.
Well, given you are executing so many deals the first 6 months, did you make any new business? Did the team make any new business calls? Were you out trying to get new business, or was it just all execution of business that was already in house?
Yeah, no, it was a lot of new business as well. It's again with our relationships on boards and investors and with management teams from over time, it actually wasn't that much different. Everybody, it was business as usual as much as we could in between all the executions. But there's always time for meeting new companies. And the neatest thing about our world in biotech always, but increasingly across healthcare, new company formation and dollars going into new company formation has been incredibly robust. So, if you stopped that new business machine, you'd sort of fall behind on a lot of new things that are being created.
Yeah. You referenced new company creation and you referenced IPOs earlier on, and kind of since March or April, virtually every IPO priced above where it filed, the filing range, and the valuations are like double what they were a couple of years ago. So the market for IPOs was just red hot. And the thing that kind of amazed me is that we're kind of back to these story IPOs. Most of the companies that went public as quote unquote platforms or stories, and not products, not phase 2 products. In fact, most of the companies that ever went public in the biotech industry have gone public without drugs in the clinic, have gone public in the last 6 months. So use great pricing, companies that are going public without products. What do you think's going on in the IPO market right now? Or what has happened in the IPO market over the last 6 months?
Sure. As you said, and I'm sure as a lot of people on the phone remember, the price for entry in the IPO market used to be human data. Used to be clinical data, and that's how we used to think about, what is this company's phase 2 data look like, or what is this company's phase 1 data that might be in a therapeutic category where you can evaluate a little bit more from phase 1. It evolved. It evolved, and it used to be that plus who are the investors, who are the management team. And then, it evolved a little bit to, who was the pharmaceutical partner who provided validation. And at this point, IPO 5.2 or whatever we're in, investors play a very, very big role. And, we used to see what we would call crossover investors very, very infrequently. So those public institutions who would invest in private companies right before the IPO, the so-called crossover or mezzanine round, we used to see them very, very infrequently. And now, those crossover investors have almost replaced the phase 2 data as a barometer that people use. Now, it also has to be, a really strong management team, a really strong board, and a really strong story, if not really strong human data. But those crossover investors do make it such that there's a foundation, there's a foundational level of support, both on the IPO and in the aftermarket, and that's a big difference. We used to have a world where the venture capitalists who backed a private company would buy in the IPO and help the company get to liquidity through that. Now we have a world where sometimes the venture capitalists will do that as well, but the crossover investors who have generally even deeper pockets will buy on the IPO and then also buy in the aftermarket. So you create this virtual cycle where these companies, you sort of know that public investors have blessed the valuation and they support the valuation on the IPO generally. And then they're typically rounding up their position in the aftermarket. So, the deal is, to your point, Dennis, we used to sort of spring companies on investors the couple of weeks before they went public. Now we have these testing the waters, so companies are getting to know investors even before testing the waters, even before they start their IPO processes. So we have a lot better familiarity. There's a lot more appetite from the public investors to own these companies privately and publicly. And I think the IPOs in biotech, especially, just given that point, they move up, generally speaking, more than they don't. And in a really perverse way, a global pandemic does remind people that how interesting and how important biotech is, just as one of the parts of healthcare. So it almost made biotech a defensive sector where people wanted to look at biotech, and there's been a lot of capital flowing in to the space. And from an IPO perspective, it's really interesting. I think, generally speaking, we track our different sectors that we're in, biotech, medtech, tools and diagnostics and services. And this year has been incredibly skewed toward biotech, just in terms of proceeds raised, where other years it's a little more equal.
Right. I mean, I'm not. I assume it's the same in San Francisco, but here in New York, we have all these boarded up stores. Restaurants are starting to permanently close. Across the country, we're closing in on 30 million people unemployed. It just seems like the business we're in is totally. Wall Street is totally divorced from Main Street. And these valuations just don't seem sustainable. And I understand about the defensive nature of it. But do you think this boom or appetite for the IPOs will continue as long, or what will stop it? Is it the crossovers who hold the key right now, the crossover investors? Or
yeah, I think.
What do you think stops it?
It's a really good question. So, there's, as we all know, there's tons of liquidity pumped into the system right now, right? And the liquidity is looking for alpha, looking for returns. So that's one of the ways, and that's how people have come to this sort of IPO asset class concept, where these deals are, they're a little bit scripted to go well. So, that combined with, I think we're in a really interesting part of the innovation cycle where, as you talked about stories, Dennis, they're actually leading to relatively important breakthroughs. We've had gene therapy and cell therapy have been around forever. People have been trying to unlock the immune system to treat oncology forever. And we're really starting to understand and industrialize some of these things. So, could we start to see, could a number of failures of these so-called story companies, high profile failures of these so-called story companies, could that impact the market? It certainly could. In the past, where we had seen the crossover investors come in to the market, we had seen times when they would go out, where the CIOs had said, you're too overweight private companies. In a market downturn, that's an easy place to get out of, because you're trapped in an illiquid situation potentially. So, it feels like to me, while the liquidity is so high, so while the stimulus is so high, and the federal governments are ensuring that almost globally. And while we've got institutional investors, willing to play in the sector, it feels like it could continue. The black swan event of a Vioxx or things like that will make people think all the time about how they're investing. But
yeah, I guess those of us that are in the industry really do understand what you're saying about the innovation. It's amazing. It used to be we would allocate these deals to the retail investor, the individual investor. Do you think the individual investor understands the innovation, and does the individual investor play a role in any of these deals, or is it all institutional now?
Yeah, the deals are pretty heavily institutional. There are certainly pockets of all of our sectors where there's a retail component. When we think about retail these days, it's often high net worth individuals that are clients of the larger banks. But there's certainly retail holdings in some biotech stocks. Obviously, COVID has brought in a lot of that, I think, into some of the biotech stocks. It's always hard. This is a high science field. So I think there's more. The good news is there's more research out there for people to see. So I haven't really tracked whether we have more or less retail, but generally speaking, but in deals, at least anecdotally, I would say it's probably on the left side, just because you're trying to fit in when you have crossover investors, at least for IPOs or even for follow-ons, where you have big investors who want their pro rata. As the markets are doing well, you're usually having to cut those people back rather than find incremental shares that you would have potentially given to retail.
Yeah. Yeah. On that particular topic, when you do an IPO, how many times oversubscribed do you want it to be?
As many as you can. Yeah, as many as you can.
Good deal. Three times oversubscribed. Is that a good deal?
Yeah, it all depends, Dennis, on we think about gross and net. We think about allocable and gross. So a lot of times we'll have inflated orders. So sometimes you get a deal that's incredibly well bid for by hedge funds, and it comes all at the end because the word has leaked that it's a hot deal. So, you can get to we've seen a bunch of these deals get to the 20 times oversubscribed, which was not anything you had ever seen in my career. But when you parse through it, it's not always, it's not always allocatable demand. A lot of times it's smaller groups or groups who just want to get the attention of the team, the management team, or of the banks with a big order, but really only want a fraction of that. So I would take a three times net versus a 20 times gross a lot of times, because it's all about allocatable.
Right. At the beginning, when Sarah introduced you, she talked about the high-profile M&A deals that you've been involved in over the years, some of the biggest in the industry. And I know that's a big part of your business. But the merger and acquisition market has been anemic compared to the financing market this year, and relative to other years. What do you think's going on there? Why has that not kept pace? And what do you see kind of over the next year for M&A?
Sure. Yeah, it has been a slower year in M&A, and it's really it's really just the reality of what's happened with COVID. We had a lot of M&A processes and projects going on when everything started to shut down, and we tried to continue them, but while we found ways, and while we've been doing financings in a virtual space for a long time, with conference calls, it's hard to do M&A. It's harder to do M&A when you can't do in-person diligence or have in-person principal conversations.
Yeah.
So what we found was we started. Well, I'm getting a lot of feedback. What we found was we started to get a lot of people just stop projects. So while in the teeth of when everybody was locked down, we were basically putting things on hold. There were some conversations that continued to happen, but it was generally where people had done due diligence, ahead of when the pandemic started and everybody was at home. So then everybody's heard the stories, or there's a lot of stories where people found ways to do site and facility diligence with drones while they couldn't do it in person. So that then it started to open up, and what we're seeing now is there's a tremendous amount of pent-up activity. Pent-up appetite. There's a little bit on the in volatile markets, it's hard for buy or sell decisions. So when stocks are gyrating around, we find it hard for boards on either side to really make a firm decision or feel great about price levels and valuation levels. But all that said, we expect, and we've started to see in the last couple of weeks, a lot of M&A deals get done as people are starting to be able to be in person, or, just getting to positions where they feel comfortable to be able to do deals. The premiums have been really quite high on these M&A deals. And, I think the pharmas in our world are continuing to want and need external innovation. And now we have a maturing, unlike when I used to track for you, Dennis, how many biotech companies had commercial products and we could do it on one hand. We have a really mature industry in biotech now. We have lots of companies that have commercial assets, and those companies are now growing up to be acquirers themselves. So we expect to see a very robust M&A activity through the end of the year and next year.
Yeah. Yeah. One of the things that's kind of getting a lot of attention these days, maybe you could just make a comment on, are these things called SPACs that are going public. Yeah. Could you explain what a SPAC is? What's that stand for? Yeah. What a SPAC is, and do you think they're here to stay, or is this just a flash in the pan?
Yeah. So that's right. SPACs are getting a lot of attention these days. It's a special purpose acquisition vehicle. So it's a blind pool of capital that people can raise to go out and make acquisitions, not really change of control acquisitions, but put large investments into private companies generally. So I would say, Dennis, we're probably in at least in healthcare, we're in the first or second inning to see how SPACs play out. We've got a growing number of them out there, both from supported and backed by institutional investors, as well as former management teams and operators who are well known in the investment community, and we're starting to see some deals get done. The issue over time with SPACs was always SPACs attracted SPAC investors. What's changing these days is some of these SPACs are attracting biotech specialists. So the trick for a biotech SPAC, at least in my world, in the old days, was you set up a biotech SPAC, you have institutional investors who are SPAC investors, not biotech investors, and then when you try to do that M&A deal, that investment to quote unquote de-SPAC, it's called, to use the capital that you've raised, then the investors could vote that down, because they didn't quite understand what a biotech company was and why you would want to buy it or own a phase 2 biotech company. Now the evolution is just that you're having these specialist investors invest in the SPACs, so it's a little bit easier to get to the de-SPACing point, and it feels a little more comfortable.
Yeah.
There's a whole wave of these new products that we're starting to see that are whether we've got the SPACs for financing, the royalty players. I know you were working on a new idea in that realm as well, right?
We're trying to kind of make healthcare look like other industries. If you look at energy or whatever, you don't buy energy, you buy oil or coal. You don't buy agriculture, you buy wheat or corn. In our industry, if you like a drug, you have to buy the company. So if you like Botox, you got to buy Allergan. If you like a drug in J&J's pipeline, you have to buy J&J, and then you buy the consumer piece and the device piece. So we're coming up with a way to play the drug directly through a futures market, so you can buy and sell futures on a specific drug instead of just buying the equity of the company. So more to come on that. We've kind of set up a private exchange, and we'll see. Kind of instead of buying the company, buy the asset that you want in the company, and you don't have to buy all the other assets or invest in all the other assets of the R&D. So I think we'll see. I think there's been a lot of interest so far.
Interesting evolution.
Yeah. I know we only got a few minutes left. Maybe, we only got a couple minutes left. Maybe somewhat quickly. Europe has not followed the U.S. in terms of financing. So what do you think's going on in Europe? Maybe let's take them both at once. Europe and then China. You have any comments on either or both?
Yeah. We're seeing Europe, just like North America, just evolving and maturing over time. We're seeing more institutional investors pop up. What's really been interesting though in Europe is we're seeing a new wave of venture capitalists. So there are a lot more companies starting in Europe, and what we'll see if this continues, but a lot of them are wanting to list in the U.S. And maybe not surprisingly, that some of those home markets haven't worked as well over time. And obviously our markets are working incredibly well for healthcare. So we're seeing a lot of influx, both from European and Chinese companies, frankly. And I mean, the Hong Kong exchange, now that the biotech companies can list on the Hong Kong exchange, that's been really attractive. But we're also seeing just as many of those companies want to come tap the U.S. capital markets. So, as I opened with, we're doing a ton of work with these, sort of multinationals thinking about fundraising all around the world, but a lot of it really targeted to the U.S. markets.
Do you have a sense about the science in Europe versus the U.S.? Do you think the science is there?
Yeah, I think so, Dennis. I think there's some. We're seeing a lot of really nice pockets of science come out of academia in Europe, just like we do here. So, to me, the science has been there, and the funding, especially the earlier stage and mid-stage private funding, hasn't been there as much. But as I said, it feels like there's a growing group of venture capitalists who are supporting new company builds over there and finding interesting science, technology, and assets sometimes.
Yeah. I guess I have to ask you about the election. Is that going to affect our space at all? Or will it affect our space?
Yeah, absolutely. I mean, the first thing you worry about is just volatility, especially if it's not a straightforward election. So, if we do have a contested election, or we're spending a lot of time, in an information vacuum, counting absentee ballots and mail-in ballots, that could be disruptive to the capital markets. And then, healthcare is on everybody's talking points. We're seeing the current president trying to come up with some executive orders to make hay on drug pricing. We know Affordable Care Act will be a huge battleground area and make a big change. So, yeah, our market specialists are doing a lot of work on sort of winners and losers in a Democratic win, a Republican win, a Democratic sweep, a split Congress. So, it'll be really interesting. I think drug pricing will be something that everybody's going to try to address. So I think we're going to have big impacts potentially. In healthcare, some service providers on the services side, and insurers, depending on how Affordable Care goes. So, lots of potential impact for us. Doesn't feel like there's any really terrible near-term outcomes for us on the pricing side. It'll be continued to talk about, and we may see a little bit more. A little bit more volatility with everything that's going on with Medicare and Medicaid and all those patients. We'll see a little bit more volatility in those services stocks, depending on whether Democrat or Republican.
You talk about the innovation, activating the immune system, cell therapy, the amazing breakthroughs. As it turns out, those breakthroughs all cost $1 million or $2 million. So my final question to you, is that sustainable for us as an industry?
Yeah, it's a great question, Dennis. And the pricing, we're going to have to continue to evolve and work on these pricing mechanics, because our pricing isn't necessarily set up for cures. But you can see that with small molecules like Gilead saw. So, it'll be interesting to see how that evolves, and I do think there will be potential blockbusters in gene therapy and potentially cell therapy as we figure out manufacturing a little better. So I think it'll be a pricing and an economic discussion, most interestingly, because it feels like the science is there and going to be important.
Yeah, I think that a lot of people have some questions for you, Mike, and Sarah has been getting them. So, Sarah, why don't I turn it over to you?
Yeah, we've gotten in about 60 questions. So, Mike, you have the rest of the day, maybe the rest of the week to spend with us on some of them.
Sure.
So, very first, before I do the official wrap up for the formal portion of it, one question came in, and Dennis, I know this is probably really important for you. You need to take it. Who in the world started the H&Q conference that has now become the JP Morgan Healthcare Conference? He must be a rock star. He must be super famous. Who on earth is that? Dennis, did you have anything to do with that?
Now that Mike runs the global healthcare business at JP Morgan, he's taking credit for it. And I think that Mike taking credit for starting Amgen and Genentech too. So I'm going to have to correct him these days.
I learned from the best.
Pardon?
I learned from the best.
Yeah, that was from a good friend of yours, and I would be really bad if I did not mention that that the Biotech Showcase also takes place right next door to the JP Morgan Healthcare Conference, and that we have also made the decision to go virtual this year. We're the baby conference. Mike, as I mentioned to you the other day, we're the conference with so many companies that really want to do business ultimately with JP Morgan. That's the seal of approval, if you will, if they bank with you. No, I hope all my other banking friends don't get really mad at me for saying that, but sorry. So with that said, Dennis and Mike, I want to thank you very much for the formal portion of this today. And for those of you who need to leave and sign off right now, there will be a survey before you leave. I do want to thank our sponsors once again, and we will move quickly into the live Q&A session. So I've been looking through a number of them, and we had multiple questions on SPACs, including, please explain what they are. Are they important? One of those questions comes from a person who I believe knows you, Mike, because he said Mike. Does a SPAC remove the need for crossover investors?
Yeah, so that I think that's I think I understand that question. So one of the ways, as we talked about, the IPO market is working with you need crossover investors, and then you can go public. So some people are thinking maybe the SPAC is the way to avoid the two-step process of this crossover and then IPO and this double dilution, and you can just go into the SPAC. So yes, that is true. A lot of times what does happen though is the SPAC then raises a pipe to raise incremental capital, and that's where a lot of the leverage is for the target company or for the operating company. So you wind up having just a different way of getting investors in, and those are crossover type or institutional investors. So there is that whether it's risk uncertainty that once you get past the SPAC, then you're also doing this incremental equity deal. But yeah, it's one transactional dilution, but you also have the dilution of the SPAC itself. Okay.
The other, let me see. Basic question is, what is your outlook for IPOs and M&As? And I think you may have answered that already, but if you'd like to expand upon that.
Sure. We think right now that the market feels pretty resilient. We're going to, as I said, we're going to see some volatility we expect going through the election. And we could see a market pullback based on that volatility, based on that election. The neat thing for us right now is in that volatility. And if we do have, sort of headwinds in the future as we come out of the pandemic, there are, as I talked about, there are the largest buyer community from an M&A perspective that we've ever had in the industry across all sectors right now, and in healthcare especially. Luckily, knock on wood, our acquirers are flushed with cash and haven't been as impacted as big companies in many other sectors. So, our prospects, our equity prospects, are always very linked to how strong the M&A bid is and how strong the M&A market is. Mm-hmm. I do feel like we have that sort of that backstop on the strategic side.
Okay, that may feed into another question from your crystal ball. Do you see a continuing unicorn pipeline?
I was hoping unicorn would be almost spoken of in tech land, but we have seen some of our venture capitalists in the U.S. continue to be successful with these big ideas. Dennis called them story, but these are big story companies, and kind of audacious swings at things with big slugs of capital put in. And it frankly has worked in this current ecosystem of big investors being willing to participate in company formation. So as long as that continues, I would expect those big idea companies to continue to be formed.
Okay, thank you. Another question came in from a CEO of a company involved in the digital therapeutic space. And the question is, how do you view digital therapeutics? Are you viewing them, or will the space view them as important only for supportive care for therapeutics? Or do they see digital therapeutics as a new form of treatment? Will they be approved on their own, standalone? What is your view? And maybe Dennis, you may pop in here too.
It feels like a nascent field to me, at least. Sorry, I think it can be sort of adjunctive therapy. It could potentially, in some places, be therapeutic in and of itself. And FDA is starting to regulate those and approve those kind of products. So again, for me, it's a little bit early to declare what it will be. I think. I don't know, Dennis, if you have a different view.
No, I think the same. I mean, we do have one product approved as standalone, but I agree with you, Mike. I think it's to be determined.
Okay. Another technical question. What's the difference between book runners and lead managers, and how do they play together?
Yes. A book runner manages the book, and the book being the investors. So the book runners are the ones who are in dialogue with investors and taking orders for the book. A lead manager is a senior version of a co-manager. So the world is really split up into book runners and co-managers, and a lead is just a way to recognize a co-manager as a more senior co-manager.
Okay. Let me just saw another question we want to ask you.
Hey, Sarah, can we just clarify that? So, Mike, is the book runner really the person or the firm that really runs the show?
Like they get positioned on the prospectus, and in the left-hand corner.
Yeah.
All of that space is important.
The book runners are the ones who are setting up the meetings with investors and having the dialogue with investors. And if there's that's an active book runner. We can go really down the rabbit hole, and we can talk about active versus passive book runners. And a passive book runner is a book runner in name only. So I don't mean to complicate things, but a book runner is the one who's setting up the meetings with investors and taking their orders, and then helping the company go through the allocation process.
Dennis, did you want to add to that?
No, I got it.
Okay. There are more questions in here. So is a U.S. presence necessary, Mike, for a European company or a foreign company to raise money?
To raise money in the U.S. public markets?
Correct. Yes.
I think it's certainly helpful. Most of these companies have evolved, so they have some part of the executive team in the U.S. I'm sure there are examples where there hasn't necessarily been a big footprint, but I would say it's a pretty important piece.
Okay.
I'm thinking about the unicorns from Europe that came to the U.S. I think they all had at least offices in the U.S.
Or some representation. Because I know of a number of companies, one in particular, a Swedish company that listed on NASDAQ during COVID. So, which is really pretty extraordinary.
I think you're probably right, Dennis. I'm just not. Somebody can always come up with an exception, but I think for us at least, we would always want to see some U.S. presence.
Okay. Okay. Yeah. And then another question is how do you see the market for medtech, which has always been challenged, versus the biotech market?
Yeah, medtech, in a lot of ways, we in the biotech market are jealous of medtech because there's a steady stream of M&A that's always happening as companies mature and get commercial. They are generally quickly snapped up by the big buyers, and there's been a lot of consolidation among the big buyers. So, medtech is a little less reliant on the capital markets than biotech typically, just because the burn rates aren't as high. But it's a really fully and well functioning sort of universe of companies. And now when we think about medtech also encompassing sort of these life science tools companies and diagnostics companies, we lump them all together. It's really become quite vibrant, and a lot of investors really are looking at especially these tools and diagnostics companies as interesting bets, either supporting R&D across the industry or in terms of these the new technologies, the new molecular technologies for diagnostics specifically.
I think you're making a lot of medtech companies happy. Another question that follows on closely to that is, how do you view the IPO market for medtech companies?
Yeah, what we've seen, again, it's not as busy as biotech. It's generally on par with services, probably a little bit more active than services. Investors are receptive. We just don't have as many IPOs of medtech companies because, as I said, a lot of them can get sold as private companies and sold pretty profitably, and they can get there without needing to tap the public markets to get additional capital the way biotechs need to. But the tools and diagnostics companies have started to really become public investor fodder and drive a lot of interest.
Yeah, then we have like 3 or 4 questions, Mike, asking about the personal relationships involved in doing a deal, whether it's an M&A or raising money here in the States, especially in the time of COVID. How has that impacted due diligence, for instance? Has it made it much more difficult? Are your bankers traveling at this point? Can you comment on that?
Sure. Not a lot of travel yet. Not a lot of companies wanting to have in-person conversations. From a financing perspective, a lot of our due diligence has been over phone over the years. Obviously, there are site visits that you can't do. As I talked about, you don't get to spend much time with a management team as a group to see how functioning they may or may not be, which is important for us. But what really was slowed down was that M&A. That M&A engagement. Not being able to do in-person site visits and facility visits, being able to have, and we're starting to see it now. Socially distanced CEOs, we're starting to see are getting together and getting deals done. But it is a little trickier in a distanced environment for everybody to feel really good about getting M&A done. And as I said, we just saw a lot of processes that were put on hold, whether those were by companies or by financial sponsors who just felt like they couldn't get as robust a set of parties and as robust a demand as they would in a normal environment. Okay. So we're closing in on time. So let me ask a couple of quick response questions. One, do you think there's a new or better environment for antibacterials post-COVID? And both of you can answer that. I certainly hope so.
Okay.
What do you think, Dennis?
Unclear.
Unclear. Okay. Dennis, we have a specific question for you. They want to know if you were the NCAA free throw leader in 1967 or 68. Were you?
I think a better question is to ask Mike how he played in football at Princeton.
That's Mike, we can talk about that.
Let's move on. Why don't we just move on? And yes, I can confirm that. That was a planted question, but yes, I can confirm that for Dennis.
Okay, and then a final wrap-up question, which gets us back to U.S. politics, is you can decline and just say it's over, so to say. It has to do with drug pricing, and the question, I'll read it to you. One could postulate that the POTUS approach is so U.S. pricing does not have to make up for the low prices of the same drug ex-U.S. He seems to see value in industry on advances in COVID vaccine and therapeutics. Do you have a view on that, on his approach to pricing? Is it good for U.S.-based companies? What do you think? I hear that sigh.
Yeah, that's a tough one. I don't know that anything that he is talking about is going to be able to get through Congress. So, look, do we need to have some reform? Probably is what he is postulating right now. Something that we think is absolutely going to be able to be workable. I don't know.
Sarah, one of the things I think that we have to do better is these drugs that are coming out today are all going to go generic forever. Mm-hmm. And so we may be paying a price today, but the benefit is going to last forever, and these drugs are going to go generic. And I don't think that we talk about that enough. The value
and making the case, we don't talk about the fact that our therapeutics keep people out of hospitals. And what does it cost for people to be in the hospitals?
Peter Kolchinsky talks about it's like a mortgage. Mm-hmm. You buy the house, you take the mortgage, you pay off the mortgage, you own the house. It's like drugs, right? I mean, you pay it today, and over time they go generic. Look at the price of Lipitor today. Back when Lipitor was a branded product, everybody thought the product it was too high. Today it's cents on the dollar, and it'll be cents on the dollar for the next 100 years.
But I think the sensibility of the U.S. public is probably a little bit different. They're not looking at that. They're looking at what they're paying immediately out of pocket, and what they get hit with. And that goes into many other issues besides just drug pricing. The other final wrap up is now that we've gone through this pandemic, we've seen that there was a paucity of investment in looking at in being aware of potential new threats that could come to the U.S. And, all investment in dealing with potential pandemics or new microbes or new viruses, seemed to stop after the last one. And, now we're playing catch up. Do you think our industry will be positioned to not take the foot off the pedal so much and always be prepared for whatever else may come to us? And it's probably not just industry, it's also the mindset of government, not just here, but elsewhere.
I think that's right, Sarah. I think government has to continue to play a role. And, we do see in pockets DARPA and BARDA doing really good work and spending money well with some of our clients on, biodefense and things mm-hmm. like that. I'm hopeful that the pandemic reminded everybody that it's a national treasure to have a fully functioning biopharma industry, and important to utilize it to sort of be ahead of future pandemic purpose. But yeah, it remains to be seen. I think it has to be a partnership.
Absolutely. Okay. With that said, gentlemen, thank you so much for your time. I really, really appreciate your spending time with us. Mike, it was so nice to meet you. I wish I had had an opportunity to meet you earlier, but Dennis is always a little bit slow about these great introductions. So Dennis, thank you so much for inviting Mike to join us today. I know that the numbers of people that have registered for this salon have continued to grow while we've been, chatting today. So Mike, once again, you're very popular. So, okay, everybody. Thank you. With that said, I'd like to once again thank all of our sponsors for joining us and supporting us continually throughout this challenging time. Our next salon will focus on women's health, and that's coming up next week, actually, on September 30th. So I hope you all join us for that. With that said, we sign off. Thank you all.
Thanks.
Bye-bye.
Thanks.
Bye.